We also don't want too much money from an investor. That invokes a lot of pressure. If someone gives you a third of their net worth or a quarter to one investment vehicle, one strategy, that's inherently risky. I'd rather take 50 from somebody than 100 and hope that they get comfortable with it and then they'll bring us another 50 down the line. I'd rather find 10 investors to replace that one capital amount if necessary, because that's more important as the long term, not the short term success.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Ross, thanks for joining me today.
My pleasure. Thanks, Joe, for having me.
Yeah, looking forward to our conversation. We had a chance to catch up a little earlier. Before we dive in, love to give you an opportunity to introduce yourself to our listeners, give them a little context on the conversation.
Absolutely. Well, thank you. I am Ross Curtis, and I joined Bridgeview Real Estate in their capital markets group of BV Capital back in July of 2023. I've been responsible for the 1031 exchange and Delaware Statutory Trust, or DST program. But then recently, over the last 3 months ago, I just got promoted to president.
Well, why don't you walk us through a little bit more of your background, just like where you came from prior to BV?
Yeah, I remember fondly January of 1993 when I got my Series 7 license, because it was my birthday present to myself. Really, it was just after my birthday, and I've been in the financial services ever since. I started a big mutual fund company in Houston that got bought out and became an even bigger mutual fund company, and adding ETFs and separately managed accounts and all kinds of financial instruments, even real estate investment trusts. But then in 2012, they had a reduction, so I moved to Dallas and joined a real estate company. So I worked for a large REIT manager for 6 years in their capital markets group and trying to raise capital for their deals. And then moved into the 1031 exchange space in 2019, actually. And been in 1031 exchange and single tenant net lease properties and other strategies that make sense for investors looking for 1031 exchange to, of course, defer those large capital gain taxes they would otherwise have to incur. So, and then finally, I got over to Bridgeview in July of 2023. So I've had my licenses now 30 plus years, and I've been primarily focused on talking to financial advisors and showing them the investment products that we have to offer as a sponsor for them to show their clients. So, I've always been a B2B kind of guy, but now I'm in the B2C world. So I've learned, a lot from advisors and how they treat their clients. I'm looking forward to kind of introducing here to Bridgeview to really help us do a great job of client retention as well as client growth and referrals.
Yeah, I'm really interested to hear more about that. I mean, there are a few things about BV's structure that are different than some other operators we speak to, but also just in your background, having primarily been business facing, curious, to the differences that you've seen in migrating to the LP, kind of the direct to the LP model, what it's like communicating with individual LPs versus, larger, businesses that maybe have more process or structure on their process or kind of expectations, so on and so forth. So interested in that. Yeah. And also interested, I think, your kind of journey as a registered advisor. BV is registered. Is that accurate?
Yeah. BV Capital owns BV Securities, which is a registered broker dealer. And that's who we use as our distributor of our Delaware Statutory Trust programs through the financial advisor community. So all of our people here are licensed. And I'm a registered principal. I have my Series 24 and my 7 and my 66 and my 63. But that's a new division for us. We didn't start that till 2022. We've had the BD longer than that, and that's because I think Steve May, the founder of Bridgeview, had the vision that we want to hold our people to a higher standard. And if we have our own broker dealer and we abide by the FINRA rules and regulations and follow their rules and procedures, more compliance, more disclosure, more risk factors, et cetera, that sets us apart from everybody else. And because, we got more to lose.
Yeah.
If you break the rules in FINRA, you don't get a whole lot of second chances. It's clearly articulated what you can and cannot do. And violations are very easy for them to catch. We get audited every 3 years at least, depending on their frequency and their availability. And if they've got any concerns, they'll come sooner and without much notice. So, we we are always on our tips and toes about that and making sure that all of our files are correct and our communications are valid. We don't use the G word, guarantee, or anything like that, because it's just, it's not part of how it's supposed to work on FINRA's side. So and again, I've been FINRA registered for 30 years now. So my compliance officer and I are usually compliance and sales are kind of like the Hatfields and the McCoys and then the traditional broker dealer world. But here, compliance is my best friend because they keep us in business, they keep us safe, and they keep our investors safe, which is, at the end of the day, that's what we should all want.
So yeah, it's an interesting, again, it's like a little bit different than the way a lot of the Reg D world works. So I want to dig into that a little bit more. Obviously, there's kind of a layer of trust and transparency that's built into having a higher level of regulation. But I still think in terms of communication, one of the central themes that's come out of these conversations and just like my work in this world and what we're seeing in the reviews is that the landscape has shifted over the past couple of years. Obviously there was this period of time where there was a lot of liquidity and people were really looking for opportunities to diversify. And there were, I think Adam Gower recently called a handful of operators tourists on one of his social posts. There was like a lot of new entrants to the space is the way I would typically put it. Who figured out kind of like, okay, how to market to this and so on and so forth. Mm-hmm. And capital was, flowing relatively smoothly. We're not there right now, right? Like we're in a different spot, like liquidity is like, there's a little less liquidity, or maybe there is liquidity, but people are more reluctant to loose the pocket, the purse strings, as they say.
Agreed.
And what we've seen is, where maybe 2001 to 2023, there, marketing could get you there, could get you to the raise. 2025, 2026 probably are going to be about how we build relationships and trust and authenticity. Mm-hmm. And so I'm curious, as someone who's navigating the shift from, hey, I'm doing value-based alignment to large LPs to now I'm doing kind of like personal value-based alignment to individual LPs. I'm curious as to how you've navigated that shift. Obviously, it's only been a handful of months that you've been responsible for that part, but be curious to get your early insights.
Yeah, excellent foundation, excellent topic and conversation. This part, first of all, it's been a shame every time there's a run up in pick an asset class or pick a security, right? Whether it's stocks or individual stocks or just technology or whatever. There tends to be a madness that follows, and people get in and getting in, and sometimes they get in a little too late and they're stuck and they only there for the downside. And it's unfortunate, but that cycle will continue to happen as long as there's humans and investment vehicles out there, I believe.
Sure.
Unfortunately. But you're right. That does tend to promote, I like to use the word bad actors, but just inexperienced actors, tourists, like you mentioned. And that's going to happen, right? People are going to jump on the bandwagon from investment side as well as the sponsor side. We saw it in mutual funds as well back in the 90s, leading up to 99 tech wreck. So it happens, right? You just got to be better prepared next time to hopefully screen out those that you can. And I think that's one of the reasons I like Bridgeview is that we're not looking to quote unquote cash in. We started in 2009 and we've been around for 15 years and we do a handful of deals a year. So we're not looking to capture a wave, so to speak, but be more of a steady Eddie and only do deals that make sense. Regardless of market environment, right? Yeah, there's might be more deal flow in the good times and less in the bad times. But if we can find deals that make sense, that pencil, they're low downside risk and high upside potential, then we want to bring it to market and see if we can find the investors. And that's where it comes into, who is the right investor? We want to make sure that of course, all investors are accredited. Obviously, that goes without saying, right? But we also don't want too much money from an investor. That invokes a lot of pressure. If someone gives you a third of their net worth or a quarter, or even 20% into one investment vehicle, one strategy, that's inherently risky. And they might say they've got that risk tolerance, but do you really? I'd rather take a little bit less, if not a lot less, and spread that out over maybe a couple of BV deals or other deals from other sponsors to where I don't have that pressure. Where if things don't go according to plan, then we're not setting ourselves up for negative conversations in the future. It's really important for us to look at the customer when they come approach us and ask to learn more about one of our deals and get their full financial picture and say, we're comfortable with this amount of investment based on your net worth. So we don't want to take too much because it's just too much pressure, and if things don't work out, it could be bad for both of us. And again, not worth the risk. I'd rather find 10 investors to replace that one capital amount if necessary, because that's more important as the long term, not the short term success. You know what I mean? But going back to, I think what you said originally, communication is key, and not just that process, but ongoing. I think with real estate, you fall into this trap as a GP of, well, not much changes quarter over quarter. Sometimes not much year over year. It's kind of steady Eddie, kind of plain Jane. So there's not much really to say. So I'm not going to say much this quarter or the next quarter. And again, from my world, where I've been in equities and been in bonds and all kinds of various alternative investments, there's always something going on. There's always something to talk about. So maybe in certain asset classes, there might be not much volatility, not much to talk about, but that's where you got to get creative and share stories of what's going on around you or around the industry. So your investors are getting something from you that shows that your finger is on the pulse. You're not taking them for granted. You're not just mailing it in and hoping you're doing well behind the scenes, but you really want to paint the picture that you are doing something, that your finger is on the pulse, and communicate that. And quite honestly, and be honest, when financial statements aren't as good as they were previous quarters, disclose it and talk about why and what you're going to do to fix it. I've seen a lot of that in our industry, both on the broker-dealer side of sponsors as well as the direct investment side from other sponsors, where they hope they can fix it before it becomes so much of a problem, and if it doesn't, you've dug yourself a bigger problem. And
We don't want to do that. Let's double click on that in a second. I want to go back to kind of the allocation strategy. So is it BV's kind of? It sounds like it's a communication policy, and it's something that you guys kind of like have as a core desire, not to have one LP be over allocated to you. When do you guys start communicating that in the sales process? And is that codified, or is there are there kind of rules around that for your team, or rules? Maybe the wrong word, but how are you advising the team and communicating that? Guidelines. Yeah, guidelines. That's what I was looking for. Guidelines.
FINRA is very conservative, right? As all compliance officers and regulators are. There is no number. There's no line in the sand that says, hey, you shouldn't take more than X from any investor in any illiquid deal. That if it was, that'd be easy. Then we'd all know what the rules are and we'd all abide by it. Some broker dealers are more comfortable taking 50% of a client's net worth and putting it in illiquid investments, as long as it's spread around. Some will take no more than 5%. That's a huge vacuum, right? Between 5 and 50.
Yeah.
And we fall somewhere between there. And it really is relative to case by case. If somebody comes to me and they've done real estate for 35 years and they understand the risks, maybe we can go higher. If they're brand spanking new and this is their first LP and they're a traditional mutual fund or ETF investor, heck no, right? They would never even ask for something really, really large to go in anyway. Let's start with a little bit in, and we'll even lower our minimums for people for their first time, because again, if it's, you don't want to find out it's too much later. You want to find out it's too much now. So I'd rather take 50 from somebody than 100, and hope that they get comfortable with it, and then they'll bring us another 50 down the line, versus getting 100 up front and then thinking having buyer's remorse in 3 months or 3 years when the deal hasn't full cycled yet. And they're like, why is this money all tied up? What did I do? Why did I do that? You just you don't want that.
No, totally. And when I think that there's a practical, that apparently, there's obviously compliance implications here, but there's also just practical implication. I mean, I think when we talk about building trust and authenticity, one of the things that, when I'm talking to GPs, we're talking about is you certainly don't want to, I guess what I'm trying to say is you want to demonstrate care for the LP in the process, right? And you can't do that if you're not willing to say hey, I don't need all of that. If someone's super eager to do a deal and you're not actually qualifying, what their goals are, does this actually align? Would it be better if they spread it out? Then, ultimately at some point, just like all of us do, we're going to start thinking well, does this person actually thinking about what's good for me? And that in and of itself becomes a violation of trust. So I like how you do that. I didn't realize that was necessarily on the broker dealer side, a compliance thing. But
Maybe to
that's
that point real quick, Joe. I mean, if an investor relations, one of my guys on my team comes to me and says, hey, here's a new client, they want to do 100, I have to approve every trade. So, it's not like they just go and do it and I hope they follow the rules. I have to look at it and say, yes, we can accept this amount from this investor with this profile. So we do take suitability and what's called Reg BI from FINRA very seriously, and looking at somebody and their profile and making sure that this is a deal. So it is a group discussion, so to speak, as needed. But our guys are pretty good about knowing up front that, hey, this is this might be just right or not enough or too much.
Yeah, I think that's really great that that's front and center for you guys, and that there's layers there. Okay, let's go back to what you were talking about before. Now that we've established that, let's go to post-investment communication. You and I were talking, you were saying you'd seen some research on like communicate 13 times a year. I was mentioning to you that, one of the things we're seeing on the reviews, and we've got some research about this on the website, is that in general, pre-investment communication scores are higher for sponsors than post-investment communication scores. Yeah. Makes sense, right? Yeah. Overall review, because like our reviews, like when LPs score, there's 5 categories that they give reviews in. Those don't aggregate; they leave their own individual aggregate score as well. Mm-hmm. So it's not like the overall score is an aggregate of the 5 subcategories. They individually choose the aggregate score, and we did that on purpose. And one of the things that we noticed is that aggregate score or scores, mm-hmm. maybe the wrong word, but the stars that they actually receive correlate more highly to post-investment communication than pre-investment communication. Makes sense, right? Like, so they invest with you because of what they're told, but they're actually going to evaluate you based on what they hear. So let's talk about, and even in the case where, by the way, people have maybe gotten lackluster performance, but the GP is still communicating, they tend to get better scores than you might expect, right? And so let's talk a little bit about your post-investment communication strategy. It sounds like you're saying, hey, we want to communicate at least monthly, even if we don't have much to say. Talk to me about that a little bit more.
Yeah, I'm still getting my business plan in place for 2026, so to speak, that involves investor communications. Obviously, there's the 4 quarterly newsletters that they should expect on their investment, right? That's a standard operating procedure. Everybody should be doing that, or at least semi-annually, but I would hope quarterly at a minimum. We also do 4 what we call midpoints, where we go in between quarters. So at the 45-day period in between, June 30th and September 30th, as an example, we send out a mini update with a paragraph from the construction team or property manager, update depending on where that property is in its life cycle. And of course, highlight, maybe a current deal that we're promoting or upcoming soon deal, and a little bit about the company, what's going on here. So there's 8 right there that are pretty much cut and dry. Well, I want to add to that, and that's news about the industry or news about Texas. We're a Texas-based sponsor. All of our deals take place in Texas, except for one. We'll talk about that one later. And why we left the state and why we might not do it again. But it's a little bit about the Texas market, what's going on here, why we still love it, or where we see areas of concern or not. I just want to add more things, more touch points, because that survey we talked about, I went back and researched. It was from Cerulli. Cerulli Advisors they're very well known in the broker-dealer industry, the side of the business where they do a lot of surveys on advisors and their clients and share research all the time, every year. So and then, of course, that data is dated. That was probably from late 90s, early 2000s, before, we had cell phones and you could get information at your fingertips, right?
Right.
And back in the day, you really needed your sponsor and advisor to communicate with you because you didn't know what was going on without it, right? You could just go online and figure it out. So it was very, very new. So, but I still believe those principles hold true, is that if I don't hear from you, that probably causes areas of concern about what's going on with that investment. I've not heard from those guys in a while, or what's the latest. So I'd rather, and I don't want to send out information about our existing deals either. I don't want to spam people, because one of the most common complaints from that Cerulli survey was, well, my advisors only call me when they want to sell me something, right. and you don't want to do that either. Yeah, you want to highlight a deal maybe, but that shouldn't be the only reason for your call or your email communication or newsletter. It should be one of the many things you talk about, hopefully. But I believe in that kind of that three-pronged approach is what's going on with your deal, what's going on in the markets that we work within, and what's going on with us, right? Maybe a highlight on an employee, maybe a highlight on the firm and how we're growing or not, but just more information about the whole picture, not just your deal, but also about the company and what we're thinking and how we're managing the investment in the process overall. Right. So I think that type of information people would want to hear because I know it goes back into that. I know it's a catchphrase now of that, trust, like, and know factor. But in that, and no, I think those principles are evergreen. That should always be that way. But I know it's become a big catchphrase here lately, and now when I feel like I'm just adding that to our repertoire. I think we've always done that to a certain extent, but I really want to improve on that. And the most recent thing that we did just finally add was new investor gifts. When we get a new client, we send them a care package of thank you for investing with us, and we literally just started that this week. So I think again, as investors, high net worth, the credit investors, it should expect something nice from their GP partner that they're investing with. So that kind of appreciation hopefully will go a long way as well.
Well, obviously when you're working with individuals, like they want to feel like they're being communicated with, and I think communication equals respect at the end of the day. So it's about being, kind of respected, heard, cared for. So on the other side of communication, right? Like the thing that people care a lot about, and you mentioned it earlier, is like, how am I being communicated with when something's not going as planned? So one of the questions I often ask GPs is like, when do you think the right time to communicate is when something's going kind of wrong?
Yeah. Excellent question. You don't want to sound the alarm too soon because it could cause panic that's unnecessary because you can work your way through it, right? And you don't want to do it too late when you're past the point of no return where now you've got, potential permanent loss of capital staring you down the barrel of a gun. So yeah, there's got to be a place in between there, right? And not coming from I didn't go to, I know a finance degree or a focus in real estate from my background. I was an accounting major. So, I'm great with numbers, but, I don't necessarily know what they mean when it comes to real estate too much. That's why I'm the sales guy, not the analyst. However, I do think, and that's why capital markets and the real estate team need to talk, because we're two separate things. There's basically, because we're securities licensed, there really is a Chinese wall between what the real estate side has access to our files and what we have access to their files. So, that's where that communication comes in internally so important as well. And hopefully the real estate team is being honest with the capital markets team and saying what is going on. And here's where properties might be, have occupancy challenges or increase in expense challenges. And how can we communicate that? And what are we going to do about it? So, and I've seen this a lot. One of my previous companies where the capital markets group didn't know what was going on in the real estate side because they weren't told. They were told everything was fine. And then it was, until that point of no return where it was too late. And now it's the capital markets group that's getting yelled at by the investors because they weren't informed, but they didn't know. Maybe they should have pounded a little harder just to make sure. But it does happen, and I think because we're a small firm, I can walk down the hall and knock on the CEO's door and say, what's going on with this property? What's going on with that property? And so thankfully, we have that type of collaboration here where I can find things out. And because I do want to obviously continue to hopefully share the information that's presented to us and that's truthful. And but knowing when to share it, I'd say it's probably a case by case thing, right? Occupancy goes up and down in multifamily.
Right.
How many quarters in a row has it become a negative trend or a positive trend where you can, feel comfortable with how things are going or not? It is hard to say, but thinking back to our recent, the multifamily struggles around the DFW area because of the influx of new supply, we saw occupancy start to drop in early 2024. And not until end of 2024 did we know, this is probably going to be a prolonged thing. And then started to disclose it, probably second quarter of this year is, this has been tough. And, but we do think it's near the bottom. So we might've been a little late there by a quarter, but again, we didn't want to scare anybody, too soon.
Sure.
In that example.
Well, like you said, I think there are fluctuations in core numbers. So I think there's a balance between, presumably, like if an investor called you and requested data, they could get it. But the question about kind of mass communication is always like, all right, well, to recap kind of something you just said, like you saw a data point move, but it was unclear whether or not it was a trend or like a momentary fluctuation.
Right.
And so determining that is really important. I think, again, one of the things that I'm hearing from people consistently is it's like, okay, well, you have been entrusted and are a trusted partner in a sense by an LP. And so like they don't want you to come to them with everything. I mean, they would have done it. They would have bought their own building probably if they wanted to know about every little thing that happened.
Sure.
But then there's the other side where it's like, okay, well, what is netted out? Like, what is the impact to me? That's what they really want to know. Like, how does this impact me? What is, or at least that's my sense, again, like I'm not a GP and I'm not having these conversations specifically with LPs as a GP, but, my sense from all these conversations is, that's where the GP really needs to thrive is, hey, net this out for me. Like I gave you X dollars, like something's happening. What's the impact? But the win is, I think, a little bit of a balancing act and very kind of like firm specific. It feels like in terms of
agreed.
The timing piece.
Firm specific, asset class specific, market cycle specific. There's a lot of specifics.
Right. Definitely. Okay. So, couple more questions. We'll wrap up here. The one that we consistently ask, and you're new to this side of it, and so I'm really curious based on your early impressions, but we always ask people like, what part of passive real estate investing needs to die? Like what's no longer useful? Like what element of this market is no longer useful? All right. So, one of the things we always ask people is what part of passive real estate investing is like no longer useful or needs to die, in the words of Pat Cingarella, our CEO.
Okay. Yeah, I love Pat. I've learned this a long time ago. When I first joined that REIT company, our boss used to say, do not use the word opportunity. There are so many opportunities out there, right? And to use it over and over again becomes it's just marketing jargon, slang, and I hate it. And ever since he told me, I remember the day he told me that. I mean, it was literally 2014 probably, and I see it everywhere still to this day.
Sure.
It's an automatic tune out for me. So when I'm scrolling on Facebook or LinkedIn and I see a video pop up from a real estate sponsor, whether it's storage or multifamily or single family rentals, whatever it is, right? Opportunity. You can't miss this opportunity, right? It just, to me, it's a red flag. It is a warning sign of, okay, either they're new or they don't care and they're just trying to sell you something. And that to me is, I don't want to participate because I don't care how great you're making it sound behind that opportunity word. You're still trying to sell me. And that's not how I want it to be sold to. Again, as an accounting major, I'm more of I like to sell through education. When you help an investor or even a partner self-realize the benefits of your program or your structure or your strategy or all three, then they'll want to buy it versus me trying to convince them to buy it. It's a very different approach, right? And opportunity screams sales approach, but to me, education screams more of a self-realization approach. And that's what I like to do. Whether I'm talking to an investor or a financial advisor, it's always, I'm sure you've heard lots of stories about how this real estate deal is the best, right? I don't know if mine's the best, but here's the reasons why I think it might be a good fit for some of your clients. If they're looking for this, or this, right? Here's what we're trying to do in this strategy and outline the specifics of what we're trying to accomplish. And hopefully that resonates and hopefully that spurs a conversation. Try to learn more about what they're actually looking for to see if this is a fit versus, I've got the best opportunity. This is a great opportunity. You got to check out this opportunity, right? That's the wrong approach to me. And yet it's consistent still to this day.
Yeah, definitely, without a doubt. That's a unique one. We haven't heard that one yet, but I think it falls into the broader category of like how these things are marketed. But I totally hear you. Okay, well, this has been great. I really appreciate you taking the time. Before we sign off here, Ross, can you, if people want to learn more about you, want to learn more about BV, can you just tell them where to go?
Yeah, sure. Our website is bvcapitaltx.com for Texas. BV stands for Bridgeview. That's the name of our parent organization, Bridgeview Real Estate. And of course, we've got a LinkedIn page. We've got a Facebook page. And you can always click the contact us button on either of those, and we'll get an email to set up a call or have a discussion or send you some materials to look at. But we do, like I mentioned, maybe 1, 2, 3 deals a year. We're very selective. We're not trying to saturate the market, and we're very focused on Texas, where I think as a developer, you want to build in the path of growth is kind of what I've heard for a long time. And Texas being one of the growthier areas of the country, we still see a lot of opportunity and runway here. So I'm happy to educate and talk more about that if anyone's interested. And thank you for Invest Clearly and Pat being a great relationship manager with us, and Joe for taking the time to talk to the little me today.
Awesome, Ross. Thanks so much.
Appreciate it.